Okay, on today's show, 3 questions. Number 1, how do the economic numbers look ahead of the Fed meeting next week? Number 2, is the way you buy and sell a home about to change? And number 3, do alternative investments get better returns? Let's go. Welcome to Dentist Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Ryan.
And I'm Rabih.
It's been a while since Ryan's been on the show. We've changed the main show, so when Ryan and I record on the main segment, we just kind of start talking, and so Ryan's out of practice on like the formal intro here.
This formal stuff is killing me, Smalls. It's all right. Thank you for having me.
Ryan and I are sitting here, not in the same room, but we are sitting in the same hotel in a poorly lit. Your lighting's better than mine. It looks like it's
the
aura
camera
behind you.
Yeah, it's the camera. Yeah,
I'm in a poorly lit hotel room. Ryan and I are in Dallas. Shout out to PDA, Victoria Peterson, Bruce Baird. We love these events. They do them twice a year. So we're down here for their, what did you call it today, Ryan, when we were recording?
I keep adding words, but I think it's the Platinum Magnificent Leaders of American Tomorrow conference.
We're just totally making that up, but we love PDA.
It's not their slogan at all.
Yeah. So I would be remiss if I didn't give at least Christine Ewan a shout out. She probably is our biggest fan. So we love you, Christine. We know you're listening.
Thanks for listening.
Let's jump in. Number 1, how do economic numbers look ahead of the Fed meeting next week? Rabih, let's start with you.
Yes, I hope you guys missed the Fed because we haven't had to hear from them lately. They take February off, and now March is coming in, and what's happening on March every quarter, they issue their summary of economic projections. So all of next week is just going to be, what did the Fed say? What did the Fed think? Where are they taking us? They're going to tell us what they think the GDP is going to look like. They're going to tell us what inflation is going to look like, what employment is going to look like, and how they're going to change it. So it's once a quarter, it deserves its own segment on this podcast to talk about it. It's kind of important. But in the last week and a half, we got mainly the new update on the main 2 data points that they're going to use to make their decision, which is in alignment with their dual mandate. The Federal Reserve, as we've always said, has a dual mandate of full employment and price stability. Full employment means they don't want people to get fired. They want to keep the unemployment rate as low as possible without causing inflation. And price stability means they want to keep inflation under check and only growing at 2% a year without crushing the economy and causing high unemployment. So it's a balancing act between the two. So in the last week and a half, we've got job data and we've got the latest CPI data, which is headline inflation for the month of February. And let's look at what these numbers show us and let's try to, guess what the Fed's going to do next week.
No, so, I'm going to predict. We're going to predict.
We're going to predict with 100% accuracy what the Federal Reserve is going to do next week.
Exactly.
And this was a joke. And for those who can't see our facial expressions. But regarding the inflation rate, the year-over-year headline inflation, which includes everything, actually printed 3% year over year in February compared to February of 2020. But if we look at the trend, I'm just going to March and April last year, that headline number was 5% and it dropped consecutively until June it hit a 3, then it had a good jump up to 3 in August, September. But then since October till February now, so we're talking 5 months, inflation rate has been between 3 and 3, fluctuating in that range. It has been moving sideways for the last 5 months. But this is the headline number, not the core number. So inflation has been moving sideways for the past 5 years. It's at 3, which is above their 2% target. So let's put these 2 ideas in mind. Now, if we jump to unemployment rate, back in March and April, it was so low, the lowest it's ever been, around 3%, and started growing consecutively bit by bit, and then plateaued between August and January between 3. It was the same thing, 3, and then in February it came at 3. And actually, if you add a bunch of decimal points, if you want to be generous with the rounding, you can put it at 4. So unemployment rate finally is getting to the area where it's 4. So this tells us the economy slowdown is now showing in the lagging indicator of unemployment rate. Here's what we've gotten so far, guys. We've got inflation that dropped but has plateaued for the past 5 months, and it is a little bit over their target. And they've got unemployment that was plateauing while they were raising interest rates, but now in their last data point actually spiked up to levels where they think would become high. So if you guys were the chairman of the Federal Reserve, where are we going?
Oh, let me tell you. Let me tell you exactly what's going to.
I don't.
I'm just teasing you guys.
No,
one knows.
We've talked about this so many
Go
times,
ahead,
right? The unenviable position that
freeze.
Oh no, did we freeze? Oh, we good? You guys both froze on me.
You froze.
Yeah.
You're the freezer.
Oh, I froze. I'm the freezer.
You're the freezer.
Oh gosh,
Yeah.
dang it! Am I back?
Yeah. You're
Yeah,
back.
you were
Yeah.
gonna say something.
Yeah.
Something really spectacular.
Is it over now?
Yeah,
You
if
said it.
not,
And you're
I
not going to
can
say it again.
keep going.
Yeah. No, I'm gonna say it. We've talked about this so many times on the show of this unenviable position that the Fed is in of trying to navigate and balance the two kind of main economic risks here, right? Being runaway inflation versus causing a major recession. It feels like when you see the inflation numbers, to your point, Rabih, kind of being pretty stable now, things normalizing there, I would imagine, and they've already kind of announced, right? They've already kind of announced that they want to get ahead of cutting some rates here. So I would imagine, I don't know if it's going to be next week, but I'm going to stick with what they've kind of said, which is at least a couple of rate cuts sometime this year. I won't tell you when, but I believe them when they're saying that their goal is to try to cut rates.
Yeah, fair. I don't have an answer, but I've got a survey of different opinions that I'm going to share with you. And next week, round 2 of this discussion will be what actually materialized and what did the Fed think. So
Really fast.
the first one we're going to...
Oh, sorry. Really fast. I just
Yeah.
want to point out a good lesson here. Rabih is by far the smartest person, not even close, in this little discussion group. And his first response is, I don't have an answer.
I don't have an answer.
That's a really good life lesson to be. The smarter you get, and to be like, I actually don't have an answer, as opposed to the opposite side of the Dunning-Kruger effect, which is like, I don't know anything, but let me give you all
I
the
don't
answers.
know.
So I
saying I don't
appreciate
know
it.
is worthy.
Respect,
That's a good
Rabih. I
answer.
like-
Agreed.
Yeah.
Exactly, because
Carry on.
Matt said it when he started the podcast. I don't think here we're here trying to navigate the noise. And this week it's very noisy in terms of like how will the economic policy move forward. And I'm just here thinking out loud with you guys about like possibilities. And at the end of the conversation, I know where this is going. It really doesn't affect the portfolio that much, but we're here to navigate the noise. Let's walk through this Dune sandstorm together. In a sense.
Love it.
So I loved Ryan's reaction. Did you
So
watch the
good.
movie?
Yes, my 14-year-old daughter loves the shows and the whole world of it, and so like we're geeking out about it. I have a lot of thoughts on Dune if you want to get there.
Yeah, me too, but let's talk Fed first. So the first point about the Fed Reserve. So with what we were talking about the markets, at the beginning of the year, we were saying on this podcast that the Fed has communicated 3 rate cuts by the end of the year, but the market was pricing around 6 or 7. Well, looking at the Fed funds futures, this has changed. And now the market, which is a good sign because now there isn't really a disconnect between economics and capital markets. But on the other hand, if you zoom into those inflation numbers, the CPI, the main sector that's keeping it at this level and plateauing at this 3.1 level and not allowing it to drop down is shelter, because shelter is still around 5% year-over-year inflation growth. However, if you look at the trend of shelter, it's been very consistent. It's just been very, very slow. So one of the hypotheses that the Fed might come up with, yes, we are seeing a slowdown in the economy. Unemployment rate ticked up to 3%. Are not worried about this 3% level of inflation because we know it's influenced by shelter, and shelter is a lagging indicator because rents take time to shuffle and there's a slower turnover rate, as we've talked about it before. So the answers, one of the hypotheses for what the Fed is going to say is that, no, we're going to focus about the unemployment number now. We're going to communicate that, yes, rate cuts are going to be happening in Q2 20, simply because the inflation data we're seeing is much lagging than unemployment. The other conversation, and we'll see which one is more correct next week. The other way they are thinking about it is that, well, inflation stuck at 3 will actually change our anchoring on what we think expected inflation is going to be at 5 years, 7 years, 10 years. And when inflation expectations get de-anchored, that's a bigger risk than current tick in unemployment where a bunch of people get fired and you go into a short recession. So now it's going to be, will the Fed favor making sure their credibility is in stone, they are keeping inflation expectations anchored, or will they favor the Fed is going to balance now between both roles and their dual mandate, and given that some data is more lagging than the other, they'll focus on unemployment. And we'll see, but it's a very interesting conversation, and if it tells us anything is that really no one knows and no one can predict the future, even the Fed, and we are working this as new data comes in and as policy battles its way into actual execution.
That's it. Curtains.
Silence.
I froze again. You guys froze.
Yeah.
Internet here is not the best, unfortunately, but we'll piece this all together. Rabih,
Yeah.
can you lean in a little bit more on the concept of you saying this kind of like unanchoring of inflation and the risk there a little bit?
Yes. So, and this whole concept and terminology and language actually came from the inflation crisis we had in the 70s, where no matter how much the Federal Reserve kept on increasing interest rates, they could not bring inflation down. And that was not because inflation year over year, when you're looking at it in 1 year period, was actually much higher than the interest rates. Paul Volcker shot up interest rates to 18%. Inflation was not 18% in 19. But what was happening is that what people expected inflation is going to be 5 years from now and 10 years from now, which is very different than what happened in the last year. It's your expectations were not anchored around what the Federal Reserve said. So currently, what the Federal Reserve says, our goal is to keep inflation at 2%. That's our inflation target. It means your money between year 4 and year 5 is going to only grow by 2%, and between in inflation terms. And the money from year 7 to year 8 will also move by 2%. When inflation expectations get de-anchored, what happens, instead of you basing your, forecast on Fed policy, you base it on what happened last year. So what you would say, oh, in year 3 inflation was 10%, I expect inflation between year 4 and year 5 to be 10%. And oh, inflation in year 6 was 15, I expect it to be 15% between year 7 and year 8. And because we know compounding adds up, that expectation keeps increasing every single year, which causes a huge de-anchoring. And the repercussions of that is that suddenly you go in an income wage spiral where employees are asking for more money because they can't afford their groceries, and the groceries are getting higher because companies need to keep their margins. And you go down an inflation spiral that is really hard to get off, and hopefully not to be re-experienced.
So basically what I'm hearing, and it makes sense intuitively, is there's a greater risk to the runaway inflation or the upward spiral of inflation compared to, let's call it, a normal recession. Obviously, hopefully we're not talking like an 08-09 level. You're just saying like a normal cyclical contraction in the economy that is a normal thing we see on average, although we hit, I think last week or the week before, those cycles are now becoming wider, right, of how often we expect them. But if we say historically, you see a recession about one every 5-ish years on average is about what we normally see. You're saying the risk of that is not as great as the upward spiral of inflation getting out of control. It's harder to rein that in, is what
Correct.
you're saying.
Exactly. But this is not the case we're in right now. What we are looking at is inflation from last year. It's still at 3% because housing and shelter is expensive. If we actually look at expected inflations, just to do the apple to apple comparison in your example, Matt, they are well anchored around like 2%. So it is not that case where, oh no, we really need to care about inflation spiraling out. That was the conversation a year and a half ago. Not anymore, thankfully.
Not anymore. But I guess that the Fed is still worried. It seems like that if they were to, that they could tip that scale if they cut rates too quickly.
Exactly, because it's expectations, and they are the ones who change all expectations.
Got it. Okay. Ryan, any thoughts on this before we move forward? I don't know if Ryan can hear us.
Okay. Hello? Are you talking to me?
Are you there? Yeah.
It's the worst connection ever. It's like
we had a
the
bad
internet
connection.
is so bad. Yeah, it's really bad.
So did you hear any of that?
Question if you just looked at me and asked me a question? I did hear all of it, but then good. Everyone was staring at me. Okay.
You're good. I was just saying if you had anything else to add to Rabih's segment here.
No.
Okay.
Heavens no. Nope. Thank you for that. It was really helpful.
Some magic finger editing on this one.
A lot of editing. Yeah.
So, okay, we'll move on. So next question we want to cover is the way you buy and sell a home about to change? So this is actually an add-on to what we talked about. I don't remember when this was. I want to say it was a couple months ago. There was a big settlement. There's actually multiple settlements and lawsuits going on right now with the National Association of Realtors. I don't know if you guys knew this, but the National Association of Realtors is the biggest lobby group in America. Like, they are huge.
Really? The biggest?
Yes,
Whoa.
The biggest. So they are, or at least top 3. But from the article that I was reading when we first did this, it said it is the biggest lobbyist group in America. So they have a lot of power. Well, an article came out actually today that was talking about one of the other, so they call it a groundbreaking legal agreement with the National Association of Realtors. The title of this article is Realtors Reach a Settlement That Will Change How Americans Buy and Sell Homes. And so, again, we talked about this a little bit before, but essentially what they have been basically through these class action lawsuits, the argument being made is that the National Association of Realtors have been keeping commissions basically inflated by the way they practice, by the way that they're doing things. It's kind of, they're basically calling it collusion between realtors, between on the buy and the seller side, to keep commissions the highest in the world. And so I actually did a little bit of digging and wanted to kind of set the stage first of how high, kind of how rare is the commission kind of structure and actual levels in America versus the world. So a couple of things I wanted to hit here first. So real estate agents by country. The U.S. has more real estate agents than Australia, the United Kingdom, and Canada combined by a long shot. So there's 1 million real estate agents in the country. There's only 100 in Canada. There's only 48 in the UK, and there's only 35 in Australia. Now, obviously, part of that is population. So, but here's the even more interesting. So the use of agents in the U.S. compared to all other countries. What would you guys guess for a percentage, like when you talk about transactions happening, what percentage of people use an agent, a buyer, like for this is from a buyer side? What percentage would you say use them?
I'm going to say that 67% of transactions use an agent.
Rabih?
I'd go over Ryan. I don't have a number, but I'll go over
68.
Ryan.
You're going to price is right me?
67.
89. So 89% of all transactions of all buyers are using an agent. All other countries, it's about 33%. So outside the US, basically only a third of people actually use. So in Australia and the UK, less than 5 use agents on the buy side. Last
because
thing here.
Do you know, do you know why? They have different, is it because of some of these laws that are being changed now around the commission structure?
Yeah. So the US is pretty unique in the sense of the seller pays the buyer's agent. So that's one of the things they're trying to change with this whole structure. I've always found this very weird. Like, why is the seller? So one of the practices they're trying to change is when you go as the seller, you're using an agent. That agent is posting beforehand what they will pay the buyer's agent. So to me, the incentives there are just not aligned. It's how could you argue that there's any alignment? It's like kind of open collusion. What's going on?
Yeah, no, I'm raising my hand because I don't know like when the connection will let us actually talk.
Oh,
so yeah, but when the statistic, it's so bad. But the statistic what was the percentage? 89?
89%. Yep.
So
used
89
buyer
in
agents.
buyer agent transactions. That makes a lot more sense thinking about the current laws, because you don't pay, technically you're not really paying a commission as the buyer. You don't pay your agent, it's coming from the seller, which sucks to be a seller when you're like, oh my gosh, I got to pay like 6 figures out of the home equity in this dumb box that I've been pumping money and repairs and taxes and HOA fees into for like decades. I'm going to pay like 6 figures to someone, for both sides of the transaction. It's such a weird thing, but that the incentive makes sense why so many buyers would use an agent. It makes total sense. The barrier.
Yeah, totally. Well, and to this other point, Ryan, of kind of like what does this mean? Why is the U.S. using them so much more than other countries? I think the other thing that's happened in other countries that is hopefully happening now in the U.S. is the way you use an agent. So it's like, can I just use an agent for the paperwork? Like, depending on your situation, like, can I kind of a la carte this? A lot of times it's right now in the U.S. It's like I have to use an agent for the whole process and just pay the set commission that I have no control over. And so that's what a lot of these settlements have come down to. So speaking of commissions, speaking of when you look across the world, the U.S. is one of the highest in the world as far as our standard commissions we pay. So there's only 2 countries that have higher commissions for home sales than the U.S. So it's Japan and Argentina. Japan is on average typical around 6. Argentina is 6. The US is 5. Again, if we just compare that to countries like Australia, the UK, and Netherlands, they're all about 2.5% or lower. So the US is definitely one of the highest. And again, a lot of these settlements that are happening right now and all these class action lawsuits, and it's basically the National Association of Realtors is really going through it right now, trying to battle from all these different angles. But pretty much all signs are pointing to commission, not only how much commissions are, the actual commission you're paying, but the structure and how you're paying it is about to is changing. Like, it's absolutely changing. All signs are pointing to it being more of a separation of like, Ryan, you're the buyer, I'm the seller. You pay your agent, I pay my agent. Which makes sense. Like, that to me makes so much sense. I've never really truly understood why we do it the way we do it in America. So anyway, I'll leave it there. What thoughts do you guys have, if any?
Yeah, the first time I ever sold a home as a seller, I was so confused. I thought I was hearing it wrong. Like, what do you mean I'm the one paying the buyer's agent too? Like, what are you talking about? That's not true. That's not real. Don't pay them anything. Like, I don't care. Don't pay them. Like, it was weird to me. I didn't know that was the actual thing. And so that was a strange thing to learn. It is weird. That's a really weird, I keep using the word weird. It is weird.
It is, though.
I've
never fully grasped it. It's never made a ton of sense to me. I'm not the brightest bulb in the tanning bed, so maybe I just thought maybe it was just a me problem, but it has never really made sense to me. So now it feels good that it's being confirmed that it hasn't made sense to a lot of people, and it's leading to this point of these huge lawsuits. And so anyway, I'll throw this to Rabih. Any thoughts on this at all?
Brokers do what they have to do. What I'm wondering about is, why is that rate so high in the US compared to other places, like 33% and other places around the world? Like, the gap seems shocking. And I wonder whether the seller and the buyer actually have alternative ways to clear the transaction. Is it because you only have to go through brokers that this collusion has happened? Hasn't? Like, can't you just go to the county, shake hands, sign a paper, and leave? Like, why aren't there other ways to clear the transaction than through, I'm not saying competition between realtors, because obviously there's so many of them here, saying competition between the ways you can actually clear the transaction, whether it was through a realtor or through, like, I don't know, just going directly and record it, just like you sell a car. You just give someone the title and you exchange cash.
Yeah, Matt. Well, Rabih, you'll probably be familiar with this too. You see the billboards everywhere. There's a company in Utah. They've operated in a couple other states as well, called Homie. And it's probably been tried in other places too. It's been like an uphill battle from what I understand. And they've made a lot of headway, I think. But it's a company that facilitated transactions the way Matt was saying, which is like, why can't we just use, can I just pay someone a set amount of money to just do the listing, or just do the paperwork, or just look at my contract when it's time to sign, or, an a la carte approach to services on what I want. And that company, I'm naming them specifically because the only one I know of that's done this, although maybe others have tried. That's exactly what some companies are trying to do, and provide like that other tiers of service and access to a realtor's expertise and ability versus like just the full thing, But I know that's been an uphill battle, and I think there's been a ton of lawsuits around it, and like the way they advertise, there's been like very public fighting over it. I mean, it's a very kind of fascinating thing.
Yeah,
like,
and
disruptor.
There's mixed reviews on that company in particular, or those types of companies.
I've used them, by the way. I guess I should full disclosure. I've used them.
Disclose your conflict of interest here, Ryan, please. No, so I'm with you. I think there's innovation around the creation of companies like that. Here's what I'll say, and by the way, to make it very clear, I am in no way, I don't think any of us are in any way disparaging real estate agents. I think there's the quality agents out there. No. They serve a very distinct role. But I will say, I think overall, this is a good thing. Because I think stuff like this will, and this article talks about this, of how many agents it will push out of the market. And why I say that's a good thing is, I think whenever there's a shakeup like this in an industry, it's kind of like the cream rises to the top, right? Like the quality agents, the people that are actually adding value, will still always have a role, I think, in this industry. I think stuff like this the ones that are fearful, I'm sure, of this are the ones that know that they're not doing a good job. And like any industry, dentists, advisors, real estate agents, there's always crappy ones out there. So I guess I just look at this as saying, this is better for the consumer, in my opinion. I think it's going to be better for the consumer once this all shakes out. It'll push the crappy ones out. One thing I will mention on this, there's a real estate industry analyst on this who predicted, based on these lawsuits, and they're projecting out a 30% reduction in the $100 billion a year that Americans pay in real estate commissions. So they're projecting that to be reduced by 30% per year overall. So again, more money in the pockets of people to do other things with. I think generally speaking, this shakeup will be a good thing.
Matt, this is reminding me a lot of when the robo-advisors hit our industry, reinforce. And I had the same reaction in our own industry against the same threat to our own jobs, which was, no, this is actually really good. Lower barriers to entry for the consumer, lower prices for the person who wants that type of service model versus something more expensive and more comprehensive. It only makes it better for everybody, including the people working in the industry. I think that improves everybody. So I felt the same way.
If you're good at what you do.
If you're good at what you do, yeah. So there's a little brag.
Yeah.
It's a little flex.
I mean, maybe it is, but I'm just saying, if you actually take your job seriously and you actually are confident that you're adding value to what you're, there's always a place for you. There's always a place for you. So I think the people that are freaking out about robo-advisors taking your job or AI taking your job or this lawsuit taking your job, I'm sorry, but I'm going to be like, I don't know if you're that good at your job then, if that's what you think is going to, if that's all it takes to push you out.
Yeah. Yep. Amen.
So,
Agreed.
All right, let's move on. Last question. Do alternative investments get better returns? Ryan, I'm going to give this to you. We kind of doubled down on this today with another show that we did, but we wanted to get Rabih involved in this conversation.
Yeah, I want to see Robbie's face as we talk about this. So this will be kind of a teaser because Matt and I just recorded a full episode with some commentary and thoughts around this. But there was a recent news article that I found about a Monet painting that was recently sold, that was last sold in 19... And by the way, I don't know how to read or pronounce French whatsoever. I can't even approach it, but I did find the name of this painting and I won't even try it. It's just like 6 words that I can't even remotely say correctly. Rabih, you speak French, don't you?
I do a little bit. Are you going to put me on the spot?
I'm going to right now, I'm going to Slack you right now a link to the article and the painting. So as I'm talking, you go in there and then tell us the name. It's like halfway down. Okay. So here's the title of it was the title of a news story, but Rabih, I want you to hear the numbers on this because I want your gut reaction first. It says this Monet painting just sold for nearly $13 million. It was last purchased in 1943. Gut reaction when you hear that amount of money, 3 turning into 13 per million since 19. What's your gut reaction on the rate of return, the average rate of return over that period of time?
Gut reaction, Rabih. Don't
gut reaction.
Gut reaction.
Below 10, over 10, over 20.
Oh my goodness. Here's my gut reaction. What's the number? It's definitely over 20.
Okay. Whoa, cool. Yes.
That's your gut reaction. Yeah.
It's everyone's gut reaction. So cool. Okay. So when you do the math on the 45 years of 300 turning into 13, the math exactly, what do we say is 8, Matt? Let me go find it again. 8 is the annualized average rate of return since 19. Rabih, this is what was so interesting.
Which is the same as.
Which is the exact same. And these are very basic examples. Rabih could blow us out of the water with some more specific, better ones. A basic general U.S. REIT fund since 19 also produced 8 annual rate of return. A U.S. only stock and U.S. only bond portfolio 64 produced 8 since 19. S&P 5 since 19 produced 11 over that same period of time, which compounded the money to, instead of 13 per million, compounded the money to 46 million. So what we thought was so interesting about this, Rabih, and we talked about this on the other episode that'll come out after this, is just how the human nature reaction to hearing the numbers behind an investment like this is that it's a very good return just because of the nature of the investment and the size of the numbers here. But what our brains don't immediately compute is the length of time and the compounding that happens over that length of time, and how even going from this piece of art to the essence of a few points higher makes a dramatically increased pot of money at the end that's very, very generationally different if those two choices were made differently. So anyway, that was a really fun kind of thing that we talked about. Did you find the name first of all, and then what do you think about this?
For the name, is it this? Because if that's it, it says matinée sur la Seine, Tempney, which means an evening on the Seine River. And I think Tempney, if I'm not mistaken, means like no storm, like clear skies.
So cool. Cool. Yeah,
but
that's the name.
This is, by the way, one of his most famous paintings ever.
Okay,
so
me and Matt didn't catch that off the bat.
We did not know
that's
this.
one. Okay.
We didn't say that at all.
Rabih just calling us out like, hey, you idiots.
So uncultured.
This is like equivalent to Starry Night, just so you know. Yeah.
Crap.
Let's sponsor a DA trip to Europe where you just tour museums. It would be a blast. I wouldn't shut up. So the second point, and here I'm gonna actually give you guys some amazing credit on the episode with Daniel Crosby that I was listening to on the gym a couple of days ago. And he said that our brains are not wired to deal with markets. And this is the same exact example. I do this for a living. And when you ask me for a gut feeling rather than an actual, spreadsheet answer, I will fall short for the same biases. Our brains think linearly. The markets work exponentially. That's why for me to get from the 3,000 to the 13 million, I linearly needed a return that's over 20%.
Yeah.
If you're actually looking at the exponential path, it's actually only 8, which I'm not going to be too hard on myself just because we all are humans that fall for the same thing. It's more about how, if you're a professional, how do you actually approach it through the correct mathematical approach. That's it. I still had one point, but I kind of forgot what it is. Yes.
Well, that's okay.
While
Thank you. While you're thinking of that, I was just going to say the reason why we even brought this up in an episode is because I screenshotted this and sent it to Matt. And in the time that I had screenshot it, I thought the same thing. This must be an insane return. I did the quick math, and then this became a subject to talk about because the return was so much lower than I initially assumed too. And I was like, oh, this is an interesting talking point because I think every person is going to have the same reaction. Maddie.
Yeah, this is what we talked about too, is when you look at this as a headline, right? You see this story, you immediately go to, holy cow, how lucky is that person? Or how sexy is that investment, these alternatives? Or maybe I should be investing in art. It seems so unattainable when you see the number. And to your point, Rabih, and to what Daniel Crosby talked about, our brains, like we just need to give I love that you just said this, Rabih, like you're not going to beat yourself up too much because you shouldn't. You're the smartest dude I know. And you're like our brains still just the human brain does not grasp compounding. Just like let that go. Just release yourself of any blame of thinking you can understand compounding, because our brains just literally cannot fathom that when you look at those numbers, it only was 8% rate of return. The key there is 45 years. This solidifies everything that we talk about all the time. The financial writers that we know and love so much talk about that. It's not about tactics and strategy. It's about temperament, behavior. It's about discipline, patience. This type of return is attainable for everybody. We just said it. Ryan just said it. A 45-year time horizon.
Matt, you cut off at temperament and it was dead silent after that. It's like perfect time.
But I think your audio still gets uploaded, so
I think the audio does still get uploaded.
The audio
so
still
I
gets
ruined it.
No.
Yeah, you totally. This is your fault.
I will edit this one.
You
I
can
will
edit
edit this one for students.
Everything you just said will get uploaded, but finish your thought if you were not done talking.
Everything I just said was absolutely incredible.
Hotel podcasting is amazing.
Hotel podcasting is the best. Okay, I will just finish it there. I don't even remember what I said after temperament.
If you completed your thought, then you can just edit from there and
yeah, I think the key here again is just to emphasize that time, discipline, patience, like these are the things that you need to be successful with investing. And that's why I love this example you gave, Ryan, when you found this article, is someone sees this and thinks, holy cow, this seems so out of reach. How lucky is this person? Whatever you want to call it. It's like, no, everyone can do this. Everyone can have this. If you have time, patience, and discipline, you can attain this.
Yeah. Yeah, the lesson here is that the skill is not picking the right investment. The skill is surviving the investment. I mean, that's the whole skill, is just survival, which nobody does well. That's why it's the main skill. Yep. So yeah, really interesting stuff. So that's a good teaser too. Thanks, Rabih, for the input. We just did a whole episode on it. That'll come out after this one. So stay tuned. Keep your eyes peeled in a theater near you for a new episode.
Like and subscribe.
Subscribe.
Well, Rabih, any final thoughts? No? Crappy internet.
Just a head shake.
Crappy internet aside. Appreciate Rabih and Ryan being here.
Thanks, man.
This is gonna take some editing. We're gonna end this the same way we always do, which is plugging the Dentist Money Summit. It is around the corner, guys. It is around the corner. We are so excited. We actually, again, here at PDA, Victoria Peterson's one of our main stage speakers. So we've been chatting with her and her team that are coming out to Park City. So this is June 21st and 22nd. Check it out. We're actually going to be doing a few giveaways here the next couple of months where you're going to have an opportunity to get fully comped hotels and fully comped tickets through some raffles and things that we're going to do. So looking forward to that. I'm frozen again. I can tell. Yep. Here we are. Okay. We're back. Are we back, guys? Am I frozen? Why is it only me? I don't understand this.
It's so weird, man. It's so weird.
Anyway, everything I just said was amazing, just so you guys know.
Okay.
I'm going to edit this one.
Love you.
Okay, well, thanks, guys. That was our 2 cents. Only one thing left to do. Go forth and live your rich life. Bye-bye.